Over the last few days, we've been rocked by the news that LendInvest have released a sub 4% buy-to-let mortgage rate. This is incredible news considering that the Bank of England's base rate is currently 5.25%. And to be honest, most of this year, we have seen our mortgage market rocked by unprecedentedly high mortgage rates. Since this has happened, my inbox has been flooded with messages asking me, Sam, how the hell have a buy-to-let lender managed to get a mortgage rate at 3.99% when the base rate is still so high? Not only are we going to be answering that question in this video, but I'm also going to go into detail into how you can actually work out which is the most cost-effective mortgage product for you, as well as towards the end of the video, going through a couple of little pitfalls, a few things you want to watch out for when you are choosing a mortgage product based on interest rate and fees. So stick around. Hi everybody, it's Sam here. Welcome back to the channel. Now today we're going to be discussing the news that LendInvest, a buy-to-let mortgage lender, have released a rate of 3.99%, which is pretty astonishing considering that the Bank of England base rate is 5.25%. Now before we get into it, please can I ask a huge favour, and that is to not only subscribe to the channel if you haven't already, click the notification bell to be alerted to future videos, but also please hit the like button. This really does help me as I plan to try and grow my channel to 5,000 subscribers by the end of the year. It's just a small click for you, but it means a hell of a lot to me. Now let's get back to the video. Now, as I was saying earlier on, specialist buy-to-let mortgage lender LendInvest have released a new 2-year mortgage product that is fixed at 3.99% for 2 years. And as I said, I've been getting a ton of messages asking me how this is possible given that the base rate is at 5.25% at the moment. Well, in actual fact, there are 2 reasons why LendInvest are able to do this, and there's another reason as to why they want to do this. Now, the first thing to understand is the mechanism of how lenders actually lend money on mortgage products. Most mortgage lenders, especially the specialist lenders, actually borrow money from larger institutional banks like JP Morgan, Citibank, RBS, and the like. They do so using something called swap rates, which essentially is a rate that predicts what they think the cost of that funds are going to be over the course of a period of time, generally 2 years, 3 years, 5 years, 7 years, and 10 years. Up until recently, the cost for borrowing money on a short term has been pretty high. In fact, for the most part this year, it's been higher on 2-year swap rates as it has on 5, 7, and 10-year swap rates. Now, as our economy has improved, we started to get some confidence back into our market, especially as we've seen a massive reduction over the last few months in the rate of inflation. This has a positive effect on those swap rates and means that the cost of borrowing between banks has actually come down. Those swap rates are well below the Bank of England base rate at the moment, so as you can see, this does give an option for lenders to borrow money to lend to you on rates that are cheaper than the Bank of England base rate is currently. Having said that, that is only part of the puzzle, and the other way that lenders get around this is by increasing their lender fees. Now, most lenders will incorporate a fee as part of their mortgage product. When we go back a few years, a lot of these were fixed fees, so something like £999, £1,999, something like that. More recently, they've become percentage-based fees, and particularly more recently, as rates have started to increase, we've seen these fees go up, and there's a very good reason for that. When it comes to buy-to-let mortgages, we need the rates to be as low as possible because the higher the rate, the harder it is to actually borrow money because lenders will use a rental calculator to work out how much you can borrow. Without going into it, essentially, the higher the interest rate, the higher your rental income will need to be to allow you to borrow the money that you want to borrow. Now, with rates going higher and higher over the course of the year, that has put a lot of strain on landlords who haven't been able to get that magic 75% loan to value. So mortgage lenders have been forced to change tactics, and what they've done is they've reduced the rates so that the rental calculator works, but they've still had to make up their margin. Okay, they are borrowing money using swap rates that are a little bit less than the Bank of England base rate, but they're still not low enough to make these calculations work en masse. So what they're doing is they're raising their fees so that they can make their money on those fees. Now, this LendInvest rate of 3.99% actually comes with a 7% fee, which is pretty high. Going back only a couple of years, the percentage fees were generally somewhere around the 1 or 2% mark, so a big increase there. So now we've discussed how lenders can actually get those cheap rates out. we need to talk about which types of products are going to be best for you and how you can work this out. Now, obviously, I'd always recommend using a good mortgage broker like us at Grand Union Finance to go through these calculations with you and research the market fully. But I do think it's really important that you understand how brokers actually work this out so that you can be a little bit more on the ball when it comes to making a decision. Now, it's always been the case that we have to factor in not only the interest rate and the monthly payments and the interest that you're going to be paying, but also the fees when it comes to working out an overall cost for comparison. And this is how we do that. Firstly, we're going to add up all of the interest payments that you're going to make over the fixed period. If we use the example of this LendInvest product at 3.99%, this is on a 2-year period, so we need 24 monthly payments to add together. What we then do is add on all of the fees and we get one figure that we can use to compare to other products. As you can see from this, the higher the fee, the more impact this will have on the overall cost, and it could mean that for your circumstances, the best and cheapest and most cost-effective product for you isn't actually the lowest interest rate. Now, I've done some of this hard work for you, and I've actually looked at a few different loan sizes and made comparisons between the LendInvest 3.99% 2-year fixed rate with a 7% fee and some of the other LendInvest products, and indeed some other products on the market that perhaps have some lower fees. Now, a lot of the time, this LendInvest product is still coming up as being the cheapest overall. But as I mentioned at the beginning of the video, there's a few things you need to consider when taking out a product that has such a high fee. Now, you don't actually have to pay these 7, 6, 5% fees up front. Generally, what lenders do is they add them onto the loan. So you actually have to incorporate that when you're working out your monthly payments, to use the calculations we were previously, especially if you're taking out a shorter term fixed rate, in this instance, a 2-year fixed rate, the product that we've been discussing today, because when you add that fee onto the loan, you are being taken over that magic 75% loan to value. Now, if like me, you expect that house prices are actually going to dip over the course of 2024 and maybe only have a slight recovery going into 2025, as you can see, by the time we get round to the end of that 2-year fixed rate, the value of your property may be roughly the same as what it is when you take out the loan. It might even be a little bit lower. Now, this is where you have to be mega wary, because if you've added a 7% fee onto this loan, you might be at 76, 77, or maybe even 78% loan to value. And if you come to the end of your fixed term and you want to then refinance because you want to avoid falling onto a standard variable rate, you're probably going to have to pay down some of your loan in order to get a new 75% loan to value product. This will be an unwelcome expense, particularly if you're like most of my clients that are looking to grow their portfolios and as a result, looking to leverage as often as they possibly can so that they can continue to grow their portfolios out. The last thing you want is to have to dip into your deposit pot for your next property to pay down a loan that you already have. So as I said, nothing I'm saying on this video constitutes formal advice, guys. If you do want to go through your circumstances, you need to speak to a good mortgage broker like us at Grand Union Finance. You'll find a link down in the description below to get in touch with me and the team. We can book in a call with you, go through your circumstances and make sure that you are getting the absolute best mortgage for your circumstances. Thanks very much for watching, guys. Hopefully you've enjoyed it. If you have, then guess what? You might actually enjoy one of my other videos. In a couple of seconds, YouTube is actually going to recommend 2 more videos to you. So stick around and I'll see you on the next video. Thanks for watching.